Listen, something extraordinary is happening in Venezuela right now. And if you're not paying attention, you're missing one of the biggest infrastructure plays of the decade. We're talking about a country sitting on 303 billion barrels of oil. That's 17% of the entire world's reserves, more than Saudi Arabia, more than Canada, more than anyone. And right now, all of that is locked behind rusted pipelines, broken refineries, and decades of complete infrastructure collapse. Here's what most people don't understand. When President Trump stood up last week and said American oil companies are going to spend billions rebuilding Venezuela's energy sector, he wasn't just making a political statement. He was essentially ringing the opening bell on what could become a $500 billion infrastructure bonanza over the next 10 years. And I'm going to show you exactly which companies are positioned to grab the biggest pieces of this pie, because most investors are looking in completely the wrong direction. Everyone's focused on the oil majors. Chevron this, ExxonMobil that. Sure, those companies matter, and we'll talk about them. But the real money, the smart money, isn't betting on who pumps the oil. They're betting on who fixes the broken machinery that makes pumping possible in the first place. Think about it this way: Venezuela's oil production peaked at 3.5 million barrels per day back in the late 90s. Today, they're barely scraping together 800,000. That's a collapse of over 75%. This isn't because they ran out of oil. It's because everything is broken. Let me paint you a picture of what broken actually means here. We're talking about power grids that can't keep the lights on at production facilities. Pipelines so corroded they leak more than they transport. Refineries that haven't seen proper maintenance in over 2 decades. The state oil company, PDVSA, has been hollowed out by corruption and brain drain. All the experienced engineers, gone. The technical experts, they fled years ago. What's left is essentially an oil industry running on duct tape and prayers. Now here's where it gets interesting for investors. Rystad Energy, one of the most respected analytics firms in the business, just put out numbers that should make your ears perk up. They estimate that just to maintain Venezuela's current pathetic production level of around 1 million barrels per day, you need to invest $53 billion over the next 15 years. $53 billion just to stay where they are. But that's not the play. The real opportunity is in the rebuild to get production back to historical levels. To push Venezuela's output back toward 3 million barrels daily, which is still below their peak, you're looking at over $65 billion purely for infrastructure rehabilitation. We're not even talking about drilling new wells or exploring new fields. This is just fixing what's already there. Repairing pipelines, rebuilding refineries, restoring power systems, replacing equipment that was literally stolen or left to rust. And every single dollar of that $65 billion has to flow through specialized companies that know how to do this work. This is where the investment thesis gets crystal clear. You've got 3 major categories of winners here, and most people are only looking at one of them. First, you got the oilfield services giants. These are companies like Halliburton, SLB, which used to be called Schlumberger, and Baker Hughes. When Maduro's government fell and Trump started talking about the Venezuela rebuild, what happened to these stocks? Halliburton jumped 10% in a single day. SLB popped over 10%. Baker Hughes gained 4%. The market immediately understood what Wall Street analysts are now scrambling to quantify. These service companies are the picks and shovels of the oil industry. They're the ones who actually do the technical work. They run the drilling operations. They manage the well interventions. They provide the artificial lift systems. They handle reservoir optimization. Venezuela's fields are particularly challenging because most of the oil there is extra heavy crude, really thick, viscous stuff that requires advanced extraction technology. You can't just stick a pump in the ground and watch it flow. You need sophisticated equipment and deep technical expertise. Here's what makes this opportunity even more compelling. SLB and Baker Hughes never fully left Venezuela. They scaled back operations when things got really bad, but they maintained a presence. That means they have institutional knowledge, existing relationships, and familiarity with the specific geological challenges of Venezuelan fields. When the money starts flowing, and it will, these companies don't need to start from scratch. They're already there. Halliburton has similar advantages. They've worked in Venezuela before, they know the terrain, and more importantly, they have the global scale to mobilize quickly when contracts start getting signed. The second category of winners, and this one's flying completely under the radar for most retail investors, is the refining complex. Now stay with me here because this gets a little technical, but it's crucial. Venezuelan crude is heavy and sour, which means it has high sulfur content and is really thick. Most refineries can't process this kind of oil. But you know who can? Gulf Coast refiners. Companies like Valero Energy, Marathon Petroleum, Phillips 66, these guys have spent decades building refineries specifically designed to handle heavy crude. Now here's why this matters. When Venezuelan oil production ramps up, where's it going to go? It's coming to the United States, specifically to Gulf Coast refineries. These facilities will suddenly have access to a cheaper feedstock because heavy crude typically trades at a discount to lighter oil. That means better margins. That means more profit per barrel processed. Valero has already been in talks with Chevron about resuming Venezuelan crude shipments. The market caught on fast. Valero's stock jumped over 7% when the Venezuelan news broke. Marathon and Phillips 66 saw similar pops. Some refiners were up 15% in the initial reaction. What makes refiners particularly interesting right now is that they've been struggling with tight margins due to high crude prices and economic uncertainty. Venezuelan heavy crude gives them a way to improve profitability almost overnight, assuming the barrels actually start flowing. And here's the kicker. Even if oil prices stay relatively low, which they have been, refiners can still make money because their business model is based on the spread between crude oil input costs and refined product output prices, not the absolute price of oil. Now let's talk about the third winner category. And this is where things get really interesting. Infrastructure and construction. We're not just talking about oil infrastructure here. Venezuela's entire country is falling apart. Roads, bridges, ports, electrical grids, telecommunications, you name it. When regime change happens and a country opens up for business, especially one as resource-rich as Venezuela, you see a massive wave of infrastructure investment across every sector. Companies like Fluor Corporation and Caterpillar are positioned to benefit enormously. Fluor is one of the world's leading engineering, procurement, and construction firms. They have experience rebuilding infrastructure in challenging environments, and Venezuela will definitely qualify as challenging. Caterpillar makes the heavy equipment that construction firms need. Bulldozers, excavators, generators, all the big machines that move earth and build things. If you're going to rebuild an entire nation's infrastructure, you need Caterpillar equipment or something very similar. The beauty of the infrastructure play is that it's not just about oil. Venezuela needs everything. New power plants to keep the lights on, modern ports to handle increased export traffic, roads to move equipment and materials, housing for workers, commercial real estate for businesses. One consultant, Charles Myers from Signum Global Advisors, is already organizing investment trips to Venezuela, and he's talking about this being a $500 billion opportunity over 10 years. His client list includes not just oil companies, but construction firms, auto manufacturers, chemicals companies, mining operations, and major asset managers. Think about what $500 billion means. That's not a one-time injection. That's sustained investment year after year after year. That creates a multi-year tailwind for any company involved in this rebuild. And here's what separates the smart investors from everyone else. The smart money isn't waiting for perfect clarity on Venezuela's political situation. They're not waiting for all the sanctions to be formally lifted. They're positioning now while everyone else is still scared and uncertain. Let's ground this in some reality, though, because I'm not here to sell you a fantasy. There are real risks. Venezuela's political situation remains incredibly messy. We just had a regime change happen through military intervention. The acting president, Delcy Rodriguez, initially pushed back against U.S. involvement, but has recently started signaling openness to cooperation. That's a good sign, but it's not a guarantee of stability. If the political situation deteriorates again, if violence breaks out, if there's a power vacuum, all these investment plans could evaporate overnight. The sanctions framework is another complication. Right now, most U.S. sanctions on Venezuela remain in place. Chevron operates under a special license, but for other companies to jump in legally, you need sanctions relief. The Trump administration seems committed to making that happen, but the details matter. Will it be gradual, performance-based relief tied to political benchmarks? Or will it be sweeping changes all at once? The timeline and structure of sanctions removal will directly impact how quickly investment dollars can flow and how fast production can ramp up. Then there's the math problem, and this is important. Global oil markets are currently oversupplied by about 2 to 3 million barrels per day. Oil prices have been weak. Brent crude fell 19% last year. West Texas Intermediate dropped about 20%. In this environment, oil companies are being very cautious about where they deploy capital. For Venezuelan projects to make economic sense, companies need to believe they can make money at current and projected oil prices. Here's the challenge. The break-even price for Venezuelan heavy crude projects is estimated around $80 per barrel. But oil has been trading in the $50 to $70 range. That's a problem that, if oil prices stay low, even with sanctions lifted and political stability established, major oil companies might not commit the tens of billions needed for full-scale development. They'll be selective. They'll do the easy stuff first, the low-hanging fruit that can generate returns quickly, but the massive infrastructure overhaul might take longer than optimists expect. This is actually where the services companies and refiners have an advantage over the oil majors. Halliburton, SLB, and Baker Hughes get paid for the work they do, regardless of what oil prices are doing. If Chevron or anyone else starts drilling, these service companies get contracts. The oil price matters less to them directly. Similarly, refiners benefit from the spread, the differential between heavy sour crude and light sweet crude, and that spread can be profitable even when absolute prices are low. Let me tell you who's already making moves. Michael Burry, the famous investor from The Big Short, publicly stated he owns Halliburton and sees upside in Schlumberger and Baker Hughes specifically because of Venezuela. Burry's thesis is simple. Venezuelan pipelines and refineries are in disrepair, and U.S. contractors will get that work. Chevron is already there with existing operations. ExxonMobil and ConocoPhillips have been fighting legal battles for years over assets that were seized, and they might finally see some justice and compensation. Retail investors have caught on too. According to data from J.P. Morgan and Vandatrack, net daily retail inflows in a Halliburton hit the highest level since early 2022, right after the Venezuelan news broke. Chevron saw retail inflows spike to levels not seen since summer. Baker Hughes and SLB experience similar surges. The retail crowd understands this is a real opportunity, even if the exact timing is uncertain. Now let's talk specific positioning, because this is where theory meets practice. If you believe the Venezuela rebuild is happening and you want exposure, you've got several ways to play it with different risk profiles. The most aggressive play is going straight into the oilfield services stocks: Halliburton, SLB, Baker Hughes. These stocks already moved on the news, but if the rebuild actually materializes, what we've seen so far is just the beginning. Analysts estimate it will cost $10 billion annually just to turn around Venezuelan production. That's recurring revenue for years. Halliburton is particularly interesting because they have global scale and expertise in heavy oil. Their stock trades at about 13 times forward earnings, which is reasonable valuation for a company that could see a multi-year growth cycle from Venezuela work. The risk here is execution and timing. If Venezuela's political situation stays unstable or sanctions relief drags out, these stocks could give back their gains and then some. A more conservative approach is the refiner play: Valero Energy, Marathon Petroleum, Phillips 66. These companies benefit from heavy crude access, but they also have diversified businesses across the U.S. refining complex. They're not totally dependent on Venezuela. If Venezuelan crude never flows in significant volumes, these companies still operate profitable refineries processing other feedstocks. But if Venezuela does open up, the margin expansion could be substantial. Valero and Marathon both trade around 13 times earnings as well, offering decent value with upside optionality. The really conservative play, and this is for people who want broad exposure without picking individual winners, is looking at infrastructure ETFs or energy sector funds. The Global XUS Infrastructure Development ETF gives you exposure to a basket of construction and infrastructure companies. The Energy Select Sector SPDR fund holds the major oil companies and service firms. You won't get the same explosive upside if one company really crushes it, but you also avoid the risk of picking the wrong horse. Here's something else to consider that most people miss. Chevron is the only major U.S. oil company that stayed in Venezuela through all the chaos. They maintained operations, kept relationships intact, preserved institutional knowledge that positioned them to benefit immediately when conditions improve. Chevron currently produces about 20% of Venezuela's total output and exports roughly 140,000 barrels per day to U.S. refineries. If production scales up, Chevron scales up proportionally because they already have the joint ventures and infrastructure in place. But here's the twist. Chevron already popped 5% on the news. The market has priced in some of this opportunity that ExxonMobil and ConocoPhillips are in a different situation. They got kicked out of Venezuela years ago when Chavez nationalized the oil industry. They've been fighting in international courts ever since. ConocoPhillips is owed close to $10 billion. ExxonMobil is owed around $2 billion. If there's a settlement, if they get compensated or allowed back in to recover their assets, that's a catalyst that isn't fully priced in yet. The geopolitical angle matters too, and this is something that could either accelerate the opportunity or kill it completely. The U.S. is clearly trying to reassert influence in Latin America and reduce Chinese involvement in Venezuela. China has been Venezuela's main oil customer during the sanctions period. They've invested heavily in Venezuelan infrastructure, and those investments complicate any U.S.-led rebuild. There could be conflicts over contracts, ownership stakes, existing agreements. Navigating that requires diplomatic skill, and probably some compromises. On the flip side, if the U.S. can successfully manage the transition and establish a stable, market-friendly government in Venezuela, you're looking at a completely transformed energy landscape in the Western Hemisphere. Venezuelan oil production returning to historical levels would add over 2 million barrels per day to global supplies. That's not huge in the context of global demand of around 100 million barrels daily, but it's significant enough to impact prices and regional supply chains. For U.S., energy independence and security. Having a reliable, heavy crude supplier in the hemisphere is strategically valuable. That it reduces dependence on Middle Eastern oil, it shortens supply chains, it gives U.S. refiners more flexibility. These strategic benefits could drive government support for the rebuild beyond just economic calculations. That means potential financial backing, easier permitting, maybe even some risk guarantees for companies willing to invest early. Let me tie this all together with a clear action framework, because information without application is useless. First, accept that this is a high-risk, high-reward situation. Venezuela could absolutely fall apart again. Political stability is not guaranteed. Sanctions might not get lifted as quickly as Trump suggests. Oil prices could stay low, making projects uneconomic. If you can't stomach that level of uncertainty and potential volatility, this isn't for you. Stick with boring index funds. But if you've got risk tolerance and you want exposure, here's a tiered approach. Start with a small position in the service companies, maybe split between Halliburton and SLB. These are your core Venezuela plays. They have the most direct leverage to infrastructure spending, and they're already seeing market recognition. Keep the position size manageable, maybe 2 to 5% of your portfolio, depending on your risk profile, because these stocks can be volatile. Add a position in refiners for diversification. Valero or Marathon would be my picks, because they have the right refinery configurations for heavy crude, and they've signaled interest in Venezuelan barrels. This is a slightly less direct play, but offers good risk-reward because refiners have other profit drivers beyond Venezuela. Again, keep it sized appropriately. You're building a basket, not betting the farm on one outcome. If you want exposure to the majors, consider a small position in ConocoPhillips. They have the arbitration claims that could pay off big if there's a settlement, and they're undervalued relative to their asset base. ExxonMobil is safer, but larger and less leveraged to Venezuela specifically. Chevron already moved, so I'd be cautious chasing it here unless you're very bullish on multi-year production growth. For the infrastructure angle, look at Fluor or Caterpillar if you want pure play exposure to rebuilding. These companies benefit from Venezuela, but also from broader global infrastructure spending. So you get optionality without putting all your eggs in the Venezuela basket. Caterpillar in particular is attractive because they have pricing power, steady dividend growth, and diverse end markets. Finally, and this is crucial, have a plan for taking profits and managing risk. If these stocks run hard on positive Venezuelan news, don't get greedy. Infrastructure rebuilds take years, maybe decades. There will be setbacks, delays, political drama. Use strength to trim positions and lock in gains. The numbers are staggering: 300 billion barrels of oil, potentially 65 billion in infrastructure spend just for rehabilitation, hundreds of billions more for full redevelopment, 500 billion total opportunity over a decade. Those aren't small numbers. Companies that successfully capture even a small piece of this opportunity could see transformative growth. But it's not a sure thing, and that's what separates this from ordinary investments. You're betting on political stability in a country with a terrible track record. You're betting on sustained commitment from the U.S. government across potential administration changes. You're betting that oil economics makes sense at current prices, that you're betting that execution goes relatively smoothly in one of the most challenging operating environments in the world. A lot has to go right. The investors who will make serious money on this are the ones who position early, size appropriately, and manage risk actively. They're not the ones who wait for perfect clarity, because by the time everything is obvious, the opportunity is priced in and the easy money is gone. But they're also not reckless. They understand the risks, they could diversify their exposure, and they have exit plans. If I had to summarize the Venezuela investment thesis in one sentence, it would be this. A country with world-class oil resources and completely destroyed infrastructure is opening up for business, creating a multi-year opportunity for service companies, refiners, and infrastructure firms. But success requires navigating significant political and economic risks that will separate winning investment from disasters. The companies best positioned are those with existing presence, technical expertise, and financial strength to weather uncertainty. Halliburton, SLB, and Baker Hughes for services. Valero and Marathon for refining.